Hello friends, if you receive Social Security and you have ever been surprised by a tax bill at filing time, there is one form you should know about before tax season gets close again. The form is called Form W-4V, Voluntary Withholding Request. And the reason it matters is simple. Some people collect Social Security all year, with little or no federal tax being withheld. Then, when they file their tax return, they discover that part of their Social Security benefits may be taxable. By that point, the bill can feel like it came out of nowhere, but many times it did not come out of nowhere. It came from a timing problem. The tax was not being paid during the year, so it arrived all at once at tax time. Now let me be very clear right away. This does not mean every person on Social Security should withhold taxes. It does not mean everyone owes tax on Social Security. It does not mean this form lowers the total tax you legally owe, and this is not personal tax advice. What it does mean is this: if your Social Security benefits may be taxable, and if you keep owing when you file, voluntary withholding may help you pay federal income tax throughout the year instead of facing one larger surprise later. That is the real alert today. Before we get into the details, if you are not subscribed yet, hit subscribe and turn on the bell. Social Security, Medicare, IRS forms, tax rules, and senior money mistakes can be confusing, and most people are never personally walked through them in plain English. I break these topics down so you know what to check before the deadline, the bill, or the surprise arrives. Now let's walk through this step by step. Part 1. Why Social Security can create a tax surprise. A lot of retirees assume Social Security is automatically tax-free because it is a government benefit. That is not always true. For federal tax purposes, some Social Security benefits can be taxable depending on your overall income. The IRS does not just look at your Social Security check by itself. It uses a formula that includes your modified adjusted gross income, certain non-taxable interest, and 1/2 of your Social Security benefits. In plain English, that means other income can push part of your Social Security into the taxable zone. That other income may include wages from part-time work, pension income, IRA withdrawals, 401 withdrawals, interest, dividends, self-employment income, rental income, or other taxable income. For married couples, the income picture can become even more important because both spouses' income may be considered on a joint return. Here's the part many people miss. Tax withholding from a job is normal. Tax withholding from a pension may be normal. But Social Security does not always withhold federal income tax unless you ask for it. So a retiree may go through the year receiving monthly Social Security payments, using that money for groceries, utilities, prescriptions, insurance, and normal bills. Then, when the tax return is prepared, the preparer says you owe. That is the moment people feel blindsided, and for someone living on a fixed income, even a tax bill that is not huge can still hurt. A few $100s can affect the whole monthly budget. A larger bill can create real stress. The goal is not to scare you. The goal is to help you see the issue early enough to plan. Part 2. Who should pay close attention? You should pay close attention if you receive Social Security and you also have other income. That could be a pension. It could be IRA withdrawals. It could be a part-time job. It could be investment income. It could be a spouse's income. It could be a required minimum distribution. It could be income from selling assets. Or it could simply be several smaller income sources that together change your tax situation. You should also pay attention if last year you owed more than you expected when you filed your federal tax return. You should pay attention if your tax preparer told you that part of your Social Security was taxable. You should pay attention if you recently started a pension, started IRA withdrawals, got married, lost a spouse, went back to work, sold property, or changed your filing status. And if you help a parent, spouse, neighbor, or older relative with paperwork, this is one of those quiet tax issues that may be worth reviewing before filing season. Now, who may not need this? If Social Security is your only income, your benefits may not be taxable, and you may not need to file a federal return just because you received Social Security. But do not rely on a guess if your situation changed or if you have other income. Check the current IRS rules or ask a qualified tax preparer. Also, if you already have enough tax paid in through pension withholding, job withholding, estimated tax payments, or another source, you may not need withholding from Social Security. So the question is not, should every senior file W-4V? The better question is, am I likely to owe federal income tax because of my Social Security and other income, and would voluntary withholding help me avoid a surprise? Part 3. What Form W-4V actually does and what does not do. Form W-4V is the Voluntary Withholding Request. It is used to ask the payer of certain government payments to withhold federal income tax. For Social Security recipients, the simple version is this. You can ask Social Security to withhold part of your monthly benefit and send that withheld amount toward your federal taxes. This is not a separate benefit. It is not free money. It is not a discount. It is not a secret program. It is also not a way to erase tax that you legally owe. It is a way to pay some federal income tax during the year instead of waiting until you file your return. Think of it like smoothing out the bill. If no tax is withheld and you owe at filing time, you may have to come up with the money all at once. If withholding is set up during the year, each monthly Social Security payment is smaller, but the tax is being paid along the way. That can make tax season less painful for some people. But there is a trade-off, and this is where you need to slow down. If you withhold too much, your monthly Social Security payment goes down more than necessary. You might get more back at refund time, but that does not help your monthly cash flow if you need the money during the year. If you withhold too little, you may still owe when you file. So this is not a form to fill out randomly. It is a form to consider carefully. Also remember this, Form W-4V is about federal income tax withholding. It is not a complete answer for every state tax situation. State tax treatment can vary, so if your state tax is Social Security or retirement income in any way, ask a qualified tax preparer or your state tax agency what applies where you live. The safest way to think about it is this. W-4V is a planning tool. It is not a magic tax break. For the right person, it can reduce the shock of tax season because some tax has already been paid during the year. For the wrong person, or if the wrong withholding level is chosen, it can reduce monthly cash flow more than necessary. That is why the decision should be based on your actual tax picture, not a guess. Part 4. The withholding choices are limited. This is one detail that surprises people. You cannot just write any percentage you want. For Social Security benefit withholding, the available federal withholding choices are 7%, 10%, 12%, or 22% of your monthly payment. That means you should not assume you can choose 3%, 5%, 15%, or a custom dollar amount from Social Security. The available choices are fixed percentages, and this matters because each percentage changes your monthly deposit. For example, if someone receives a $2,000 monthly Social Security benefit, 10% withholding would mean about $200 withheld from that monthly payment for federal taxes. That is just simple math, not a recommendation. The correct choice depends on the person's other income, deductions, filing status, and overall tax situation. A different person with a smaller benefit, lower other income, or enough tax already paid in may not need that level of withholding. Another person with a pension, IRA withdrawals, or significant investment income might need to review the issue more closely. This is why I do not want you choosing a number just because a video said it sounded safe. The smarter move is to look at your last tax return, ask your tax preparer, or use official IRS tools if you are comfortable doing that. Ask, based on my income this year, should I have federal tax withheld from Social Security, and if so, which allowed percentage makes sense? Part 5, the biggest mistakes to avoid. Mistake number 1 is assuming Social Security taxation is based only on your Social Security amount. It is not. Other income matters. Your filing status matters. A spouse's income may matter. Investment income may matter. Retirement account withdrawals may matter. That is why someone with the same Social Security check as you may have a different tax result. Mistake number 2 is confusing taxable benefits with tax rate. You may hear that up to 85% of Social Security benefits can be taxable. That does not mean the government takes 85% of your check. It means up to 85% of the benefit may be included as taxable income, depending on the formula. Then your normal tax rules apply. That distinction is very important because this misunderstanding creates panic. People hear 85% taxable and think 85% gone. Those are not the same thing. Mistake number 3 is waiting until filing season to think about withholding. By the time you are sitting with your tax return, the year is already over. You can still learn from it, but you cannot go back and withhold from last year's monthly payments. If you repeatedly owe, the time to review withholding is during the year, not after the year is finished. Mistake number 4 is thinking the highest withholding choice is automatically better. It is not. Higher withholding may reduce the chance of owing later, but it also means a smaller Social Security payment each month. That can be a serious problem for someone who needs that monthly cash flow for rent, food, prescriptions, utilities, or insurance. The goal is not to withhold the most. The goal is to withhold appropriately, if withholding is needed at all. Mistake number 5 is sending forms or personal information to the wrong place. For Social Security withholding, you are dealing with Social Security as the payer. You can manage voluntary tax withholding through your personal My Social Security account, or you can use the proper Form W-4V process with Social Security. Do not send private tax information to random websites, strangers in comments, or phone numbers from suspicious emails. And please hear me clearly on this. Do not trust a caller who says they can fix your Social Security taxes if you give them your Social Security number, Medicare number, bank login, or an upfront fee. Do not post your benefit amount, bank details, address, tax documents, or Social Security number in the comments. If someone online claims they can get you a special refund, a secret grant, or guaranteed benefit help, slow down and verify through official sources. Mistake number 6 is thinking withholding is the only option. It is not. Some people may pay estimated taxes. Some may adjust withholding from a pension or job. Some may use voluntary withholding from Social Security. Some may need a combination. The right path depends on your situation. Part 6. The questions to ask before you change anything. Now, instead of guessing, I want you to use questions. Questions keep you from making a rushed decision. Start with this one. Was any part of my Social Security taxable on my last federal tax return? If you had a tax preparer, ask them that directly. Do not just ask, am I okay? Ask whether Social Security was taxable and whether the same issue could happen again. Then ask, based on my expected income this year, am I likely to owe federal tax because of my Social Security and other income? Expected income matters. Last year may not match this year if you retired, started withdrawals, lost a spouse, sold an asset, went back to work, or changed filing status. Then ask, would Form W-4V voluntary withholding help me pay throughout the year instead of owing more at tax time? That is the main question. The form is a tool, not a command. It may help some people. It may not be needed for others. Then ask, if withholding makes sense, which allowed percentage should I choose? Do not let someone online choose it for you. The percentage should be based on your tax picture. And finally ask, if I do not use W-4V, should I make estimated tax payments or adjust withholding somewhere else? This is especially important for retirees with pensions, IRA withdrawals, self-employment income, investment income, or changing household income. Those questions may sound simple, but they are powerful. They move you away from fear and toward a real plan. Part 7. How to take action without panic. Here is a simple way to handle this. First, pull out your most recent federal tax return if you have it. Look for whether Social Security benefits were included as taxable income. If you do not understand the return, ask your tax preparer or a trusted qualified person to explain that line. Second, look at what changed this year. Did your income go up? Did you start withdrawals? Did you begin a pension? Did your spouse start or stop working? Did a spouse pass away? Did you move from married filing jointly to single or qualifying surviving spouse status? Did you sell investments or property? Those changes can affect the tax picture. Third, ask whether you paid enough federal tax during the year. This may come from paycheck withholding, pension withholding, estimated tax payments, or Social Security voluntary withholding. Fourth, if voluntary withholding from Social Security makes sense, look at Form W-4V or the online Social Security withholding option. Choose carefully from the allowed percentages. Fifth, after the change is processed, check your next payment or your online account to make sure the withholding looks right. Do not assume it happened just because you thought about it. Verify it. And sixth, repeat this review when your life changes. Tax withholding is not something you set once and forget forever. Retirement income changes, filing status changes, Medicare premiums change, IRA withdrawals change, a spouse's income changes. Your withholding may need to change too. If you help an older parent or spouse with paperwork, review this gently. Do not just ask, did you file taxes? Ask, did you owe more than expected? Ask, was Social Security taxable? Ask, is any federal tax being withheld from the monthly benefit? Would it help to ask the tax preparer about W-4V before next filing season? Many older adults are embarrassed by tax surprises. They may feel like they did something wrong, but often the issue is not wrongdoing. It is changing income, confusing rules, and no withholding during the year. A respectful conversation now can prevent stress later. So here is the plain English bottom line. Some Social Security recipients may owe federal income tax on part of their benefits when their combined income is high enough. Form W-4V does not erase that tax, but it may help some people pay throughout the year instead of being hit with one larger bill at filing time. Do not choose a withholding percentage randomly. Review your prior return, consider what income changed this year, ask a qualified tax preparer if you are unsure, and verify any change through Social Security or official IRS resources. If you feel comfortable, comment W-4V if you are checking whether voluntary withholding applies to you. But please do not post personal tax details, benefit amounts, Social Security numbers, bank details, addresses, or documents in the comments. And if this helped you, share it with someone who receives Social Security, especially a retiree, widow, widower, spouse, neighbor, or adult child helping a parent. A simple withholding review before tax season can save someone from a very stressful surprise later. Subscribe for more plain English alerts on Social Security, Medicare, IRS forms, banking scams, and senior money mistakes. The rules can be confusing, but the next step does not have to be.